In this video, I am going to explain the 3 core market analysis tools that you truly need. Once you understand these, you won't need to rely on chart patterns or complicated indicators that only create confusion and lead to mistakes. I am confident that what you learn here will be different from anything you've come across before. Let's begin. The logic of the market is quite straightforward. It rests on 3 primary components: liquidity, volume, and inefficiency. Any price movement in the market can be explained using these 3 elements. At the top of this hierarchy is liquidity, which is the actual engine of the market. Without liquidity, meaning without buyers and sellers, the market simply cannot move. Anything you see on the chart can represent liquidity, but what matters is how much of it there is. The second core element, which is the foundation for our entire approach and strategy, is volume. Volume shows how much liquidity is actively entering the market, essentially, how much money is involved in transactions at a given moment. The third key element is inefficiency. Inefficiencies are created due to the influence of volume on price, and we see them visually on the chart. They show us where the market has moved unevenly. Depending on the time frame, inefficiencies serve as the main lens for reading and interpreting price behavior. To understand inefficiencies more deeply, we need to consider 2 important factors. First, the state of the market at any given moment. The market can be balanced, where buying and selling volumes are equal, and price movement is slow or minimal. Neither buyers nor sellers dominate. This is uncommon and usually seen during very low volatility conditions. Unbalanced, which is the norm. When buy volume exceeds sell volume, price rises. When sell volume exceeds buy volume, price falls. Second, we look at the efficiency of price delivery. This also comes in 2 forms. Efficient price delivery, where both buyers and sellers are participating consistently, creating smoother price movement. One side may still dominate, but the exchange is steady. Inefficient price delivery, where the market moves too quickly through certain price ranges, leaving orders either unfilled or only partially filled. This indicates a lack of sufficient counter orders and is a signal of inefficiency. This brings us to our first and most basic tool, the fair value gap, FVG. An FVG forms when a 3-candle structure appears in which the high of the first candle does not overlap the low of the third in a bullish move, or the low of the first does not overlap the high of the third in a bearish move. This typically occurs when a surge of volume enters the market, causing price to move too quickly, leaving unfilled orders behind. In a bullish FVG, sellers were not present in sufficient quantity to match buyers. In a bearish FVG, buyers were insufficient to meet sellers. That is why when price later returns to these gaps, it often reacts, because the market attempts to fill those previously missed orders. If the candles fully overlap, then no FVG exists because the exchange between buyers and sellers was efficient, hence the name, fair value. When analyzing FVGs, we typically mark the upper and lower boundaries, and often the midpoint, 0.5 level, which is a strong reaction level and can serve as an optimal entry point. The validity of an FVG depends greatly on context and timing. However, the key principle is, in a bullish FVG, price should not close below its lower boundary, and in a bearish FVG, it should not close above its upper boundary. If it does, we may be seeing an inverted FVG and continuation instead of reversal. Let's consider an example. Price performs a liquidity raid, after which strong buying volume enters, forming 2 FVG zones. Price tests the first one but does not gather enough volume to continue. Then, it tests the lower FVG, forms a rejection block, and continues in the trend direction. On a daily time frame, each tested FVG creates a new one while price respects the boundaries, indicating strength in the reversal levels. Now we move on to the second tool, the order block. An order block is a price zone where significant volume was transacted, often involving institutional or large trader participation. Forget the idea that an order block is simply the last candle before reversal. This lacks real logic. To understand order blocks correctly, we must first identify where support and resistance form. Resistance occurs when a bullish candle is followed by a bearish candle. Support occurs when a bearish candle is followed by a bullish candle. These represent points where the balance of buying and selling shifted, which often indicates where large players open or close positions. When price returns to these areas, new volume may re-enter the market because these zones are of strategic interest. A bullish order block forms when price breaks resistance and closes above it. A bearish order block forms when price breaks support and closes below it. Large traders often use liquidity zones, such as stops placed by retail traders, to accumulate or distribute large positions. How is the order block zone formed? An order block forms when price breaks out of a key level. For a bullish order block, this usually looks like a sell candle followed by buy candles, and then a strong close above the previous resistance area. For a bearish order block, it's the opposite. A buy candle followed by sell candles, and then a close below the previous support area. Now, think of a liquidity zone or an inefficient price area. For price to move into that zone, the market needs enough selling to push it downward. Someone has to be opening short positions to fuel that move. However, once price reaches the liquidity zone, big players may be waiting there. Behind that liquidity level, you typically have the stop losses of traders who entered earlier. This makes the zone very attractive to large market participants, because triggering those stop losses provides them with the orders they need to build big positions. So even though the move ends up looking like a strong push upward, the reason is that the big players use the liquidity there to accumulate, for bullish scenarios, or distribute, for bearish scenarios. In short, the order block forms at a level where liquidity is available, and bigger players take advantage of that liquidity to enter or close large positions, which causes the sharp reversal or impulse move. This works the same way here. When price reaches the liquidity zone, it triggers the stop losses of traders who previously entered long. Those stop losses become sell orders, sell-side liquidity. At the same moment, large players have buy orders waiting in that area, allowing them to accumulate most of their position. So the sell orders from the retail traders become liquidity for the big players' buy orders. The reason the price then moves up strongly is because the buying volume of the large participant is far greater than the combined selling volume of smaller traders. When price steps into a zone of inefficiency, such as a fair value gap, it also activates unfilled orders. This often causes a reversal because those unfilled orders may belong to the same large participant who wants to complete their position at a more favorable price. That's why the formation of an order block is largely intentional and often looks manipulative. The exact same logic applies in reverse when forming a bearish order block. So why does price react to an order block zone? There are three main reasons. Open positions from the initial move are still active. The short positions used to push price down and create the resistance may still be open, possibly in drawdown. When price returns to the order block, those shorts are closed by buying, which naturally pushes the price upward. This can even cause a strong breakout. Unfilled orders become active again during the retest. When the zone is tested, the resting limit orders and new liquidity entering the market create fresh volume, which can fuel another impulse move. The order block marks a previous shift in market balance. It's a zone where control switch from sellers to buyers, or vice versa. Because of this, it becomes a natural area of reaccumulation or distribution, similar to how support and resistance zones attract attention. On higher time frames, this often appears as a rejection block, which we'll cover later. Example, bullish scenario. Price falls into a bearish fair value gap, gaining selling volume and pushing downward to rebalance a bullish FVG while clearing liquidity under equal lows. In that area, buyers enter aggressively, reversing the move. Price then breaks above resistance and closes strongly, forming the bullish order block zone. When price comes back and retests this zone, it reacts again and continues upward. If a fair value gap forms inside the order block on the same or lower time frame, this further strengthens the zone. The same structure applies to a bearish order block, but in the opposite direction. Key principle to remember. The market moves from zone to zone. From liquidity to inefficiency. From internal liquidity to external liquidity. And back again. Every move is connected. One set of orders fuels the next. The third tool we need to look at is the rejection block. Its function is basically the same as an order block. The difference is mainly in how it forms and the time frame you're looking at. Depending on whether you're on a higher or lower time frame, what appears as a rejection block in one time frame may show up as an order block in another. So the idea is the same, it represents a shift in the balance between buyers and sellers, just visualized differently depending on the chart view. How do we identify a rejection block? A rejection block is made up of two candles, and the key zone is the range between the wicks. It doesn't matter which wick is longer, both are part of the zone. If there is only one candle with a strong wick, that's just a simple rejection, which usually signals volume entering the market. In that case, the next candle often continues the move directly. For a rejection block to be meaningful, the wick should tap liquidity or rebalance inefficiency. However, if the candle closes within the wick range of the block, that still counts. The logic behind the two remains valid. Let's go through a few chart examples. In this case, the rejection block is formed on the daily time frame. When we highlight this area and then drop down to the 4-hour chart, we'll notice that the same zone shows up almost exactly like an order block. Another example is also on the daily time frame, except this one is bearish. Again, when we switch to the 4-hour chart, it presents itself as an order block zone just the same. Now, take a rejection block that appears on the weekly time frame. If we move down to a smaller time frame, here we'll use the daily, we can see that it mirrors the same order block area. So depending on the time frame, the structure may look slightly different, but the underlying idea does not change. Conclusion on inefficiencies. Any spot on the chart where the market moved in a way that didn't allow all orders to be properly filled is considered an inefficiency. It simply represents leftover or partially filled orders during price movement, and it doesn't matter why they were left behind. As for fractals, they are not inefficiencies because they form after the move has already completed. They are a visual result of the movement, not part of the price delivery itself. So to summarize, a fair value gap is an inefficient area caused by unfilled orders when positions are being opened. An order block is an inefficient area caused by unfilled orders when positions are being closed or managed. At this stage, the best thing you can do is study and test these concepts yourself. You might agree with this view or find your own interpretation. What matters is developing an approach that allows you to trade profitably. If this video helped you, make sure to subscribe, like, and leave a comment.